Hello and welcome to Brickwork Ratings WebConference Series 6. In this session, we have eminent investors amongst us, and we would like to discuss about the investment sentiments and what have been up to in the last 4 months, and how do they see themselves coming out of this pandemic period. We would like to also hear from them what are their interests, what are their dislikes, and how would Indian businesses would have to shape up to get investments from them. So with these opening remarks, I would like to hand over to Rajat Behel, Chief Rating Officer, Brickwork Ratings, who would give us a flavor in terms of what we are looking into and what the agency is looking in terms of credit trends. Before that, I would also like to introduce the August panel with us. We have Ms. Lakshmi Iyer, CIO and Head Debt Products, Kotak Mahindra Asset Management Company. We have Bekxy Kuriakose, Head Fixed Income, Principal Asset Management Company. We have Ajay Manglunia, Managing Director and Head Fixed Income, JM Financial Products India. We have Ajay Marwa from London. He's joining us at a very early time of the day. He's Head of Investments, Advisory and Management, Sun Global Investments UK. So welcome everyone, and I would like to hand it over to Rajat.
Thanks, Satish. Morning, everyone. So as Satish said, I'll just start off with how we are seeing things developing in the banking space and the capital market space. So obviously, all of it depends on how the overall economy is doing. I'm sure all of us have been getting a lot of views on where the economy is headed. All of them, unfortunately, are looking down and trending downwards. We are all looking for rays of hope within that downtrend. But for now, at least our view on the growth is in line with what most others are talking about. Our latest estimate of the growth rate in GDP was negative 5.5%. I think the market players are between -3 to I think some have already started talking about negative double digit, so -10%. So the range is large. Unfortunately, in the past, what we have seen is the range between all players have been within 10 to 25 basis points of where the growth expectations are. This time, that range has become very large, and that clearly shows the uncertainty that's there in the market. So it is difficult to predict where we are headed and how far down where the turnaround will happen, when it will happen, how it will happen, and whether it will be a U-shaped, V-shaped, hockey stick. All kinds of shapes are coming into picture now. At least the way we are seeing things for the year, as I said, negative 5.5%. But more importantly, the pain will, the way we are seeing, will last a bit longer. Some recoveries in some segments has started. There is some confidence that has come back into the market, largely driven by the initiatives of the government to push the banks to sort of lend more, make it difficult for them to just keep that money stashed in the repo market. So there we've seen some lending pick up that has given some more confidence in the market. The logistics situation in the country has started improving a bit. So the goods movement has started. The labor issue still is there with all the reverse labor movement back to the villages. That will take obviously some time for them also to get confidence and come back. But again, we have started hearing stories of people wanting to come back to work and corporates doling out goodies to get workers back to the industries. So some hope is there of things starting to stabilize, at least, if not improve. What is expected still is more demand side stimulus from the government, and I think the clamor for that has only increased over time, and possibly in the next few months, once the current moratorium gets over, which is what has been also stabilizing the market a bit, which ends in August, and the talk that is around that it may not get extended, there is a likelihood that and a hope that more demand side stimulus will come. That obviously has its challenges related to the fiscal deficit, and again, that's all over the place, and it's difficult to say where we'll end at. But we had also written an article recently that the government should open its purse and give more demand side stimulus. Uh, Obviously, the overhang is the sword of the sovereign rating downgrade, and that's something we'll possibly discuss here as to how imminent that threat is and how bad it would be if it happens for the money flow into the country. So having said that, our rating performance of the companies that we rate, there are two clear trends that are coming there. Some of you would have read the news reports about rating agencies asking for withdrawal of INC cases. So that's an increasing trend where corporates are not cooperating with rating agencies, not sharing information. So that's one aspect where the uncertainty is increased. But otherwise, we've been seeing over the last 3 years, it's not that it's the pandemic which has led to this, but over the last 3 years that the rating upgrades were coming down and rating downgrades were going up. So the credit ratio, which is the number of upgrades to downgrades, had been trending down. It used to be about 2 times. It was down to close to 1 last year. And this year, for the first quarter, it's, I think, down to less than 0.5. It will remain down. It could have been worse had it not been for all the measures that have been taken and the moratorium that is there. But a lot of companies on negative outlook or credit watch with negative implications. So we could see more downgrades in terms of the amount of debt downgraded. That ratio, if you were to calculate based on amount of debt, that's close to 0.1. So the large leverage companies are obviously getting downgraded, and we could see more of that going forward for the rest of the year. So I'll stop here for the overall picture, and maybe we'll take views from the others on what they think on the first aspect, which is obviously the most important one where everybody is talking, is the growth rate of the economy. Where do you see it heading, and when do you see a turnaround and of what nature? So if you could take views, I'll not name anybody. Whoever wants to jump in first can do that. We'll take these views from all of you. Okay, so I'll make it more complicated. Ajay, if you can start. So
yeah, Rajat, you have to mention which Ajay you want to speak first.
Exactly, that's why I said I'll make it more complicated.
Okay. So let me take the
Okay,
Ajay
Rajat.
Ajay Marwa is unmuted, so he can start off.
Yeah, I just thought, because I'm a little away from everyone else. All of you are in the middle of it, quite frankly, and probably see the suffering much more than I do. But look, it's very clear. I think Rajat was very clear, and some of the points you made are very valid. We've had a slightly different take on things. We've always looked at COVID-19, frankly, from an India context. The problem being what it is, it's a medical situation, and quite frankly, until we get out on the other side of the medical problem, some of the other attendant issues are part and parcel of it, and we'll have to live with them. The important thing, though, to distill from this is COVID is actually a little bit of a smokescreen, and unfortunately or fortunately, it shouldn't get exploited as such, and we fear that all of the time sitting overseas. Even if you look back pre-February, as we were approaching 2020, the state of the Indian economy, frankly, was in a fair amount of peril, and we were quite concerned. We were quite concerned, given the 2018-2020 sort of period where there was a lot of stress building up in the system. We could see very, very little capital expenditure taking place, and growth drivers in that sense were really absent. And there was a lot of pressure on the government to actually come out and stimulate the economy through various measures. Now, in the backdrop of this, we've seen what we've seen through COVID. Um, and like I said, the COVID challenges will remain, in our view, until you actually see the other side of the medical situation. So what we've got to do is roll back and see what really are the problems plaguing the 2018-2020 sort of situation. And in my opinion, some of those are yet to be addressed. And they cry out for attention, for detail, and for spelling out problems. You cannot wish away those issues. You cannot also stimulate away those issues, in my humble opinion. Some of this is baggage that's been carried for a while. So take the example of confidence. And I just before we went into the formal discussion, I heard Ajay Manglunia very correctly say that it's hard to sell credit. And of course, it's hard to sell credit. There's a serious crisis of confidence. And do not expect that to go away. Confidence is a function of, as far as India is concerned, consumption. That's a key driver. Of course, the demographics are always supportive, but also of stability. And we've seen a massive sort of shift in that stability view when emanating from India. I mean, all of the time until 2018-19, we would always sell India as a beacon of stability, saying, look at the number of credit defaults in India over the last 20 years, compare them with the sort of credit defaults you've seen out of China, and you will see that the two stand out, despite China being higher rated overall as an entity. And unfortunately or fortunately, that's completely changed. I think there have been crying shouts from various commentators and experts that it is time to address that. It is time to take those bad assets, put them aside, deal with them, and then focus on the rest of the economy moving forward. And if I were to then focus on that, we had a discussion a couple of days ago, views emanating from there as well as from various other sectors. If you start looking at some of the positives, and Rajat alluded to this, that there's some marginal signs of turnarounds. I think some of the key things are going to be rural demand drivers, whether it is tractor demand, whether it's the hope for a better than expected monsoon, and agricultural growth kind of kickstarting. All of those are your positives. But on the other side, you do need to cleanse the credit crisis that the country is in. And frankly, I think more than stimulating an economy, you first need to take away all the impediments which actually are inhibiting growth and inhibiting the path that you need to be on. And to do that, you need to cleanse the credit system at the moment. Unless you do that, all of your stimulation will probably not yield the type of results that you want it to yield. And I think the focus on COVID being a crisis is very appropriate. We're in the middle of it. The entire world is in the middle of it. But let's not use that as a smokescreen to tell ourselves that the problem is COVID related. It really isn't. This is a problem that really hit us in whatever it is, October 18, early 19, and we haven't dealt with it. If you don't deal with it, you are not going to be on the other side of this, even after COVID passes, and COVID will pass. I think that's the backdrop. Probably I'd like to lay out from our perspective sitting here, and love to hear the experts, sitting there in terms of their views. Thank you.
So Ajay, a follow-up question on that, and I'll just take you back the discussion we were having last October when we were in London, and one of the things which we touched upon is the the marquee IBC resolution plan for the stressed assets in India, and I guess most of the investors in that globally as well has been alluding to the fact that this has been a marquee step. However, there has been some shortcomings in terms of implementation, but overall the mood of the investors was saying that this is the right direction. Even if we see defaults, if there is a resolution plan, we are still going to get invested. However, now in this period that has been postponed, or I would say extended to a different time period, how are you seeing that? So quick question, is it a disappointment, or are you seeing again an opportunity in that?
It is a disappointment. I mean, let's be clear. The biggest concern that investors look, So I always look at 3 or 4 positive pillars that India stands upon. Whenever we sell India, and I do that for a living. So our kitchen runs on it. For me, it's my Bible. Um, 3 or 4 key things, right? Our political stability, our excellent demographics, our consumption driven economy, and inherently a US type sort of situation where our domestic demand can be a driver if we wanted to. These are really our 4 strong pillars that we stand on. Some of the key issues that we have always been structural. And unfortunately, I mean, we're having this webinar in the midst of COVID in 2020, but frankly, you roll the clock back in 2010, and we could have exactly the same panel. And unfortunately or fortunately, some of the key issues we'd be discussing would be pretty much the same. And that's the tragedy, right? We don't seem to move along some of the key structural parts we need to. And resolution mechanisms are a key. Um, we've always been looked upon as a bureaucracy. We've always struggled, to come onto the right side of any sort of dispute resolution mechanisms. There have been issues with labor from time to time. There have been issues with the environmental clearance side of things. Particularly, we've seen, a lot of our energy space go south thanks to that. A few years ago, there have been problems with coal. All of these structural issues have mired our growth path from time to time. And it's time to take a holistic view of these and attack them one by one. And what the crisis has done is exacerbated the impact of some of these shortcomings. So they're staring at us in the face even more. Under normal circumstances, you tend to ride slipshod over them almost, saying, yeah, look, we're growing at 8.5%. We're okay. Some of these things will get dealt with along the way. But that along the way has got to come at some point, right? We haven't seen that. So I think the IBC has been disappointing. International investors were looking at that very carefully and continue to look at that, quite frankly. And which is why I say that the world has come to a situation where COVID is something that we're going to live with. Whether we live with it for 6 months or 16 months, nobody knows, but we're going to have to live with it. What you have to do is look behind that and not use that as an excuse for everything that's going around. And therefore IBC is a classic, Satish. Thanks for pointing that out. We really need to get to the bottom of it and need to get a move on. I mean, there are various mechanisms at play. The very fact that you are speaking to a bunch of people sitting around the world, we'd probably struggle to get our diaries aligned to meet in your studio or anywhere else normally. But today's day and age, people are connected and we can stay connected quite quickly. And given that, decisions actually should become faster. No reason to complain that you can't get people, can't solve issues. So given that situation, we really should not use this as an excuse not to move ahead. And IBC is a big disappointment. We really need to get these structural issues out of the way.
Sure. Thanks, Ajay. I would like to come to Lakshmi now. I guess you heard from a foreign investor, but Lakshmi, I guess the life hasn't been easy for mutual funds as well. We've been facing debacles, in the last 3 to 4 years, one after the other, starting right from ILF's episode. How's life been for you, especially the last 3 months, and how are you seeing the space?
So, if I were a millennial, I would have said life sucks. And, I would have probably related that to the world of the professional world, where continuously one after the other. So, the way I call it, I talk about it with my colleagues, and when I chat with them as part of the dealing room, I always say, what, we had 3 C's in the financial markets. One is the COVID, which is the financial market or the medical world, which obviously we had financial implications. We had the cyclone C, which obviously hit largely parts of eastern India, but obviously it had its own impact for a short while, including those east or northeast based lenders. And then you had the COVID attack on mutual funds on 23rd of April, when one of the fund houses actually decided to wind down its 6 schemes. A series of that led to the 4th C, which is the crisis of confidence. And that, I think, still lingers around as far as the credit piece is concerned. Now, I have been long maintaining that I would say the transmission of credit as much as it has been the responsibility of the banks. We also have seen a reasonably vibrant capital market activity leading to such a transmission of credit via mutual funds specifically, and then followed by insurance companies, largely the non-bank entities. Now, that activity, in some sense, post INFS has kind of come to a halt, and the final nail in the coffin has been this event which emanated from mutual fund industry. So what has happened is that everybody wants Miss World or Miss Universe. So there is no life beyond Aishwarya Rai and Sushmita Sen, and our Aishwarya Rai and Sushmita Sens are the AAA PSUs. You don't want to think beyond these entities, and I think that also in itself has its own challenges. And therefore I say that for a very active credit market to be buoyant, it's important that we have the retail investors come back with meaningful conviction, because mind you, the events which happened specifically in the last quarter was not really a credit issue. Everything finally boils down into the credit issues, because the final outflow actually happened from the credit oriented funds. If you look at the month of April, and then you look at May, and then June, and we are in July right now, in just around 30 working days, the credit oriented funds actually lost around 30,000 crores, an amount which takes around 30 months to actually get into the industry. So, I'm giving you these numbers. There obviously will be variations, but I'm giving you the numbers in context 30, 30, 30, just to tell you the kind of pain it has inflicted on the mutual fund, that particular category, and that's not going to come back. And therefore, mutual funds, it's not that we don't like credits. We love owning AA minus, because we don't think that anything which has to be the bellwether, or it has to be the best in line in business, only has to be AAA. Look at gold loan companies. No gold loan company in India is rated AAA. But from a credit worthiness standpoint, one can vouch for its credentials. But can we buy much more of those in the funds which are oriented towards AAA? The answer is no. So I think there is this classic, I would say tightrope walk that the money managers in the mutual fund industry are doing. And trust me, it's a thankless job, because heads you lose and tails you lose. So I think that is the kind of situation we are grappling with right now.
Yeah. I guess Lakshmi wouldn't agree. In fact, for the last 10 to 12 years, you recollect we've been discussing these points over and over again. And we get stuck on the same point of the debt, the depth and the widening of the corporate bond market. And every time we get stuck at this point. So on that note, I would like to bring in Ajay Manglunia. Ajay, you've been a veteran in this space, and just before we started off the session, you were talking about your current, invest sentiments. Concur with Lakshmi's point, or you have a diverse opinion?
I definitely agree what Lakshmi is saying and can't afford to be disagreeing. Say it takes a large amount of time to build the confidence and start kind of delivering superior returns by way of taking a careful assessment of the credit and buying those papers in your schemes, and give a confidence to investors that see all of those are not AAA, but giving you superior returns. There is enough liquidity, and you are able to churn your portfolio and kind of keep upgrading your style of investing, in the sense of having venturing into different aspects of the credit. Like it's not only the rating which decide what is credit or what is not credit. I would say AAA is not absolutely a rating which decides that is the best of the credit. We have seen a couple of AAA rated companies not being able to kind of meet their obligations in time, but one need to be very sure that one is the intent of paying back, second is ability to pay back. If both of these are there, then rating actually doesn't matter. And that is what a careful assessment, mutual fund and other wholesale investors, including FI, have been very promptly able to take that call. But now these days, after the 2018 crisis, which was a confidence crisis and could have been resolved, as Ajay was rightly saying, that we need to kind of make a structural change and resolve that crisis. Unless until we remove or we resolve that crisis, people's confidence coming back to take a call and venture out to look at the credit and assess the quality and all that is very, very difficult. In today's environment, where liquidity itself in the bond market is taking a back seat, especially because people are not sure what is credit worthy, what is not. And simply relying on the credit rating is not a benchmark basically to decide what is likely to be on time and what is likely to face problems in meeting the obligations. So it's more of, and it's very unfortunate that with already slowing down credit culture in India since last 2 years, COVID actually came in and kind of played its role to wind up all the credit culture here. And that's why everybody is looking to look at only best quality. Nobody wants to apply their mind. Nobody wants to look at it whether it's the ability to pay, whether there is intent to pay, and all that. So people have kind of lost their confidence in the credit structures as of now, and that's why this credit is not flying in today's environment, and it will take long time. It's not going to get resolved very soon. Even if we resolve the pending cases now, which is too late, the confidence is already taken a very back seat and unlikely to come back very going forward. And the NBFCs, after the mutual funds, who were kind of aggressive to take the credit calls, have burned so much that their ability to take credit anymore is it just not exist.
Yeah. Ajay, you have a very
Satish, before we move to the others, there's been a question that's around from the audience for a while, and I think both the Ajay spoke of it. Though Ajay Marwa, you initiated, so maybe you can venture to answer this. So the question comes: how do you suggest that India cleans up its credit system? So is it just the AQR repeated, or there are more things that can be done?
Oh, that's fantastic, and I hope you can promise to make me finance minister if I give you the right answer to that question, right? So, no, thanks for that. It's probably the most vexed question for anyone who has anything to do with the Indian economy today, inside or outside. So, spot on for asking. And I'm going to take 2 or 3 minutes to answer this. So please be patient with it. I want to move the clock back all the way back to 1992. I was still in the process of joining Standard Chartered Bank. There'd been a massive crisis of confidence in the equity markets for some of us who may remember, thanks to Harshad Mehta and thanks to the scam that took place. And Standard Chartered was in the middle of that scam. It took a serious hit. It wasn't a consolidated bank in India in those times. And quite frankly, it sat on a serious situation from a confidence perspective, but also serious balance sheet crisis. And the way they dealt with it, and this is now documented history, so anybody can go and read it. They created something called OSRI, or Office of the Special Representative in India. They appointed an overseer from the United Kingdom, which was their headquarters, to come in and look at OSRI. And OSRI basically was nothing but a bad bank. They took all of the issues that they had, they put it under the umbrella of the bad bank. They appointed very competent staff to take care of it. So some of the senior most and most creditable people that they had were appointed to OSRI. And the job of that part of the bank was to resolve the existing situation. There was a carve out. There was a very top level team that was looking at the carve out. It had serious management attention, and it was dealt with separately. On the other side, Standard Chartered continued to build out its India franchise, and we all know what they did with it. The rest is history. We've got to learn from all of these experiences. They are very negative experiences, and every negative experience which people have survived and come out of is a lesson to be learned. The problem I feel in India is we don't like to learn our lessons. We like to sit on our achievements and say we've done well, and that's always very good. There's nothing wrong in complimenting yourself for the right things you've done. But if you don't learn from what you've not done, then unfortunately you'll only rest on your laurels. And the problem is we have not looked at all of the credit situations that we've had holistically and said, let's actually create a mechanism to put all of them in one place. Let's get the best minds in the country to then attempt to resolve it. Now, whether and whatever support it needs, what sort of support? I mean, let's come down to brass tracks. What do you really need? You need to identify what's the extent of the problem. It could be a $10 billion problem, could be a $100 billion problem, but it is a problem that can be dimensioned. You dimension it, and then you address funding it through various mechanisms, and you separately look to resolve it. But once you've carved that out and looked at it, then the rest of the economy can continue to function the way we want it to function. And why do we then need to target for the rest of it? Why do we need to target 7 to 8% growth? Why can't an economy which the world looks at as a growth driver alongside China, thanks to its domestic consumption, thanks to its ability to provide international products at competitive prices, and thanks to our ability to manage our currency exposure well, thanks to a fantastic central bank and a very stable political environment, why don't we use that to actually pitch some of those growth desires or growth targets higher? There's no reason why we can't achieve double-digit growth as long as you take all of these situations and move them into a separate area and manage them competently. I don't mean shun it into a corner and ignore them at all. That is not the way it will get dealt with. So the point is, we could have done this with ILFS. We didn't. We could have done this with Divan Housing. We didn't. We could have done this with Z. We didn't. The point is, when will we do it? What sort of size of problem do you need to have in front of you before you start addressing it? And if you do not address it, then it becomes a disease. And I think, quite frankly, this is far more serious than COVID when it comes to the Indian credit market. Because COVID will go. We will deal with the virus. What we will not, or at least what I don't see at the moment, commitment to deal with is the credit virus which actually exists, the confidence virus which exists. And therefore, I think that's what we need to tackle.
Yeah, Ajay, thanks for those insights. And I guess it's important to build on the aspects what you just laid. And I would like to come to Bekxy now. Again, building on what Ajay just mentioned, and also a few of the participants also raising a question, is that Bekxy, you would agree that we've seen many corporate frauds also happening in the last couple of years in terms of either misinterpreting the financial statements to overstating it, and also a lot of related party transaction, dubious related party transaction. Again, out of the last 1 year, if you analyze 12 large defaults, 8 to 10 of them would be having some of the other issues related to this. On the other spectrum, now you also have the top companies which were left in the kitty where all of you are running are also deleveraging. You can see one of the largest corporate in the country completely deleveraged and sitting on positive cash now. In this scenario, how is life for you, Bekxy? How difficult or how easy is it? Where are you finding the investment opportunities?
So, coming to your first point on the corporate fraud, yes, some of the defaults which have happened in the last 1.5 years is, as the picture is coming out, we are seeing, that there has been fraudulent transactions, related party transactions, etc. And to my mind, therefore, apart from the investors like us, institutional investors like us, one of the key player whose role also needs to be looked into is the auditor of the company, who has much closer proximity to the corporate. They have access to all the financials transactions on a much more granular, minute basis. And therefore, when we talk about this whole credit crisis, there are so many pieces to it. And, for the wheel to move ahead, we need to see all the cogs. The role of the rating agency, the role of the investors have already been questioned a lot. How did you do your due diligence? How did you give a AAA rating? Or the investors like us, how did you invest in this paper? Didn't you do your due diligence? And in that role, the auditor's role also comes into picture. And so far what we are seeing, the way all these different pieces have been treated is, in terms of punitive regulatory action. You either come down heavily or give it, but then how do you strengthen it for the future is the question that has to be asked, in terms of the quality of audit which is being done, how that can be improved, and maybe have more disclosures. For example, the RBI audit on ILNFS, if it was disclosed well within time, maybe many of the investors would not have made, the investments. So, there is some need to look into it in terms of the quality of audit being done by either the audit firms or the regulators, and in terms of the transparency of the audit findings. So that is something that we need to take into the picture. And obviously, I think we have to see ways of, how better to develop a better fraud detection mechanism. And as an investor, in fact, recently we have been approached by certain vendors who, have started trying to see how you can get more information on related party transactions, because many of these corporates which are listed, they may have, lots of subsidiaries who are unlisted, and something happens in the subsidiary by virtue of it being unlisted, the data is not available, etc., and you may miss it out. So how to bring that in the radar? There are big corporates or corporate groups who have hundreds of subsidiaries. So, how to capture that data in an efficient manner so that you detect some suspicious transactions. So this is something, investors need to work on capturing, and get technology on their side to do it. On the second part about, your question, of course, there's a big dichotomy in the market right now. On the one hand, the strong companies are getting stronger and the weak companies are getting weaker. So the blue chip AAAs, the top big PSUs and private companies, they are, enjoying record low bond yields. Today, a AAA PSU is raising a commercial paper at something like 3%, even lower than RBI's reverse repo rate. So they are enjoying the full benefit of the rate cut, the rate cuts which have been done. And, everybody is obviously clamoring for these names because of the collapse in risk appetite among the money managers, the institutional investors, be it the banks or be it the mutual funds. And the reasons have already been elaborated by the other speakers. And on the other hand, the weaker companies or the lower rated AA and below companies are facing a funding crisis, some of them, because they're not getting funding and they're facing tight refinancing conditions. Their financials may deteriorate further. So it's like a chicken and egg situation. Unfortunately, because of the events which have happened over the last 1.5, 2 years, and COVID having exacerbated the situation, this dichotomy will probably continue for some more time.
Yeah, thanks, Bekxy. You mentioned the role of rating agencies, and I guess since we are organizing it, is also we need to highlight that. So, Rajat, your views and take on this, and how are we geared up now to basically address this issue of falling behind the curve? So, over to you.
Right. Wrong question you're bringing me on in, but anyway. So as Bekxy pointed out, I think it's a important aspect. Rating agencies are supposed to be, they're considered as the gatekeepers, and you need to know well in advance what is happening, take rating actions, advance warning to investors, and so on. Unfortunately, what's happened, so some of it is obviously our frameworks, the way we have looked at credits, and there is a learning on what can be given, how much cognizance, whether it's group support, with not enough cognizance was given earlier to liquidity, because we always were of the impression that in India, at least, liquidity is never a problem. There's enough money willing to come in. at best the pricing will be up by 25-50 basis points. Money flow will not stop. All of those have gone out of the window. Liquidity in India is right now considered in any entity that we are evaluating, that's looked at with paramount importance. So every discussion, there's definitely a discussion now on how much is the liquidity, where will the money come from, and so on. So there is definitely learnings for the rating agencies as well as investors on what should be looked at in evaluating a credit. But I think still, in spite of what is happening, whatever we are trying to put in place, a big issue which I also talked of initially was this issuer non-cooperation. Today's scenario is slightly different because we are in a situation where the downgrades and the ability to get money is constrained and so on. But otherwise, in better times, where we need to be more vigilant, because that's when practices are not looked at very carefully. So in the better times, you'll always find the larger, bigger companies, AAAs and AA plus companies, will not be too willing to share information, and everybody would overlook that, saying that yeah, everything is going well, they're making good profits, so it doesn't matter. And that's when the corporate governance goes weak. They tend to take more risks, which then hit them in a downturn. So I think one thing that's important is information, getting information. The information asymmetry is very large. What a company knows and what even a rating agency gets to know out of that, there's a big divergence there. And in times like these, where the number of companies that are becoming non-cooperative, now it's very difficult to weed out the ones which are becoming non-cooperative because they don't want to share data because they possibly there's something to hide, or it's just that they don't want a rating now. But more than 50% companies have turned non-cooperative. How do I do any kind of assessment? So anytime that there is a weakness that's coming in, possibly the clients are turning non-cooperative. So it's difficult for me to take rating actions in such cases. The other things, as I said, complex structures, groups, multiple group entities, related party transactions, cross investments, even if not a related party, one lender giving to second lender who is giving it to third person, who's then routing it back to the first lender. A lot of these informations have come out, at least in the entities that have defaulted. Now, there is no way that a rating agency will be able to catch these aspects unless our accounting standards move to a level where a bit of forensic also gets built into accounting, because even accounting firms don't look at all of these aspects in their regular accounting. So whether we need to do more forensics in our regular accounting at times, at least once a year, if not more, is something that needs to be considered. But definitely the quality of data, even among the better companies, is not up to the extent that we can be sure that we have considered all aspects in doing a rating. So we have tried to implement another tool which is called accounting management and corporate governance to try and catch some of these accounting practices. But I think the companies are also smart. They also know how to manage their accounts, and not everything is going to get caught even in such methods. So it's going to remain tough, but at least I think there's a lot of learning in these last 2-3 years, which will get built into the ratings also. And hopefully we'll do a better job out of it. Now that there is also benchmarks that have been set by SEBI as to what is the maximum default rates and so on that can be there in any rating grade, there is going to be hopefully more due diligence and things will turn out to be better.
Sure. Thanks, Ajay, for the insight. In fact, I guess one of the solution which I would request the investors on the panel is to ask for frequent updates from the issuer from the rating agency. So this will allow rating agencies to have more robust coverage on the issuers, and also to see to it that this information asymmetry, what the rating industry is facing, is resolved to a larger extent. Now, on that note, I would like to now move to a different segment of our discussion, which is one of the things which is playing in the mind of everyone. In fact, all both the institutional investors as well as your own retail investors as well, is that what happens if India gets downgraded? There's been a lot of talk on that. There are a lot of surrounding, impeding issues of geopolitical issues as well. For example, right from US elections to Brexit to the trade wars happening between the talk of indigenization across continents, inward-looking areas, and finally the India-China conflict as well on our borders. So these are issues which are in the backyard, but I guess a downgrade at this stage for India is also something which has been discussed. So I'd like to take your views. How are you seeing that? What will be the impact, and how well we are prepared for that? So maybe I guess Ajay, if I can start with you, Ajay Marwa, and then we'll go to the other panelists, Lakshmi, Ajay Manglunia, and Bekxy.
No, thanks, Satish. And it's again a very pertinent question. Although, if you ask me, I think the rating agencies, international rating agencies, have been very calibrated in their approach, and currently have given a fairly long rope to India, as they say. Unless we see very little commitment from the regulatory authorities and the government to actually try and get the economy back on rails, we shouldn't fear incremental rating action. Whatever we've seen, we have, and I think some of the rhetoric we've heard, from all of the rating agencies, has actually expressed their opinion that they've given us, a tightrope, but a rope to walk on till probably first quarter 2021. But we do need to see structural reform, because there are two aspects to this. One, we always pride ourselves in saying that our external debt to GDP ratio is quite low. We can survive borrowing domestically. We really don't rely that much on international borrowing. If you look at the government borrowing program or the state government borrowing program, other than the FPI involvement, which is also reasonably limited in the context of things, we do not really rely on international financing of those borrowing programs. If you look at corporate borrowings also, corporate issuances from India are nowhere what they can be or should be, in my humble opinion. So external dependence from debt is quite low. Having said that, is that the question we really want to address in that particular fashion? And I think that's a very defensive and defeatist sort of approach. I think the approach is, and unfortunately, the rhetoric that I've heard every time we've tried to approach this question is, we do not want to export our capital market. And therefore, we're very happy for international investors to come into India, but we're very unhappy, or we don't desire, for Indian issuers to go out and issue, right? If they want to, we will put a set of regulations around it, call it ECB norms, call it what you may, call it withholding tax, all of the attendant issues that stick with it. And some of these issues have been addressed by the panel already. Some of these concerns have been addressed. If you really look at the asset management industry, again, the same crisis of confidence comes through. They're struggling to assess which sort of issues they can participate in. So that's one part of the problem. Can we actually get international financing for those situations? Yes, we can. The question should be, how do we address that? Do we actually look at credit enhancement mechanisms? I think the answer is absolutely yes. Can we create those credit enhancement mechanisms domestically? To some degree, yes. Can we rely on international agencies to support those credit enhancements? I think the answer is a resounding yes. But some of these things have not been explored. There is a crying need, in my humble opinion, to create an apex body in India, under whatever umbrella you want, whether it's the Exim Bank, whether it's the Reserve Bank, or SEBI, who actually looks at creating an infrastructure which allows mid-market entities, or to use Lakshmi's terminology, AA minus sort of entities, to come together under that umbrella, use credit enhancement, and go and access the international space. And then both these concerns go away. The concerns temporarily of a potential rating downgrade on one side, as well as the fact that those entities actually don't have credit access domestically anyway. Both these concerns reduce or get alleviated to an extent because you open them to raising financing from the international markets. Now, do international investors want to get in there? The answer is, of course, as long as you create the appropriate infrastructure to do so, they're happy to do so. So you've got to make sure that the appropriate credit is offered and it will get absorbed. So I think the answer to your question is, should we fear a rating downgrade? Yes, of course. If we do nothing, we should fear it. To what extent? To a limited extent, because our reliance on offshore borrowing is limited. But should we address this in this fashion? No. What we should do is look at where do we need capital? How do we alleviate our credit crisis? Do we have offshore solutions for this problem? And how do we access those offshore solutions? Because really, the solution is not there within the country. We've seen all of the credit channels being constrained, clogged, and pushed to the wire. We really need to look outside to solve these issues.
Sure. Lakshmi, your views on the same topic. How do you see the entire scenarios, spanning out, downgrade to India, and also the geopolitical tensions? How are you seeing at the fund?
Downgrade is relevant. I would say is relevant for both sets of investors, both domestic as well as offshore. But specifically, I think it is the offshore investors that tend to look at it. And then since we have offshore portfolios and we are talking and advising offshore investors, we understand this, that their concerns are fairly live because most of them have mandates that they cannot do below investment grade for a particular geography. And we are right there at the threshold. Second set of data points, if you see, is if the total limit outstanding. See, India is not fully convertible, so therefore we don't really allow free inflows of monies into fixed income. Of course, we do allow free inflows into equities. But if you look at fixed income, if the total limits were to be utilized by foreign investors, the percentage of debt foreign investors would own as a percentage of total debt outstanding would not even be 10%. Where are we right now at this current juncture? If you take the breakup aggregate, we would be close to about 3-4%. But if you look at state loan, 1% is utilized, 99% is remaining. If you look at government bonds, about 40% is utilized, 60% is remaining. So likewise, if you see the ranges suggest to you that foreign investors' ownership in Indian fixed income is very, very insignificant compared to quite a few of our emerging counterparts, and that includes even countries like Thailand, where the foreign ownership is more. And I don't even want to talk about Indonesia, where we were at a peak north of 40 to 43%. So I would say that. And of course, given that we are one of the only countries in the world where we have an SLR requirement, CRR all countries have, our banks or our domestic institutions are our captive source of financing our fiscal deficit. It is very difficult to envisage a scenario that countries like US continue to keep inflating balance sheet, continue to do PPPs, which is payment protections, and we as a nation cannot expend that additional. Of course, we're being mindful of the expenditure because it will all lead to a burgeoning fiscal deficit. But I think what India has done in this kind of a scenario is nothing short of commendable. It will take time to show it because India still gets counted as part of the EM pack, and foreseeably so it will be continued. But I don't think one needs to get excessively fretting about this upgrade and downgrade, because if you actually look at from other nations' perspective, there are countries with visibly worse off metrics in the developed world having better ratings than India. So yes, ratings do matter for the foreign investor. They would continue to watch with bated breath. It is in our own interest to keep our house in order. And when I say house in order, I'm talking about the fiscal deficit predominantly, to ensure that we leave no stone unturned to keep that in check.
Thanks, Lakshmi. Well, I move to Bekxy. Bekxy, your thoughts? How do you see the entire space, and what happens if India gets downgraded? How would you see your investments coming in?
So one hopes that we don't go into junk status, because it took us lot many years and lot of hard work to come into the investment grade. But as far as just to add to the points of Lakshmi and Ajay, as far as the domestic investor is concerned, I think we are constrained in the sense that we can only invest in domestic debt. And for us, the parameters continue to be as they were before in terms of credit, which is doing a bottom-up approach, seeing how that company is performing in the Indian market, etc. So per se, for the domestic institutional investor, sovereign rating downgrade may not make a huge difference, because obviously it will be the domestic credit ratings, company ratings, which matter. And for us, the sovereign is sovereign. As far as the foreign investor is concerned, yes, it would be negative, but what we have to keep in mind is that the foreign investor has already been pulling out money, even without such a rating downgrade. So this year we have had a record amount of outflow from the debt market by the FIs in excess of 1 lakh crore. They have already pulled out. Last 2 years also, FIs were net, negative in terms of their investments in the debt market. And as Lakshmi said, FIs form a very small component in terms of ownership of the total debt, be it GSEC, SDLs, corporate bonds, etc. So FIs had anyways not penetrated Indian debt much, and even when they had, you had a good amount of FIs who were arbitrageurs or who were mostly coming into the sovereigns and AAA and the short-term segment of the market, maybe up to 3 year, 5 year, etc. So there is a lot of scope in terms of, the government has been working on opening up limits, making things conducive for India's debt to get included in the global bond indices, etc., so that we can incentivize the FIs to come back, invest in a big way. So far, we have not felt the pinch of these FIs taking out money because, of course, their ownership being less, and because RBI has been supporting the domestic market in a huge way. They are doing massive amounts of open market operations. Last year, they did OMO purchases. They did an innovative tool called Operation Twist. So RBI is standing as the third big leg, apart from the banks and the insurance companies, the PFs and other institutional investors, and they are supporting this huge borrowing program of the government. How long they can do it is questionable. This year, of course, we can expect RBI will be there in a big way, but eventually we will need, FIs to come and invest in our market in a good way, and hopefully we will see some traction in terms of getting included in the bond indices. A beginning has been made where government has said special securities will be issued where FIs can take unlimited number, etc. And more than that, there are a lot of operational hassles. Every few months, limits getting changed, rules getting changed for FIs. I mean, it's crazy. So I think simplification of those rules, operational rules, all those settlement hassles, they have all taken a lot of time. They could have been done much faster. And even now, there are a lot of hassles on those issues. So I think if the operational things are at least sorted out, those things at least will at least incentivize FIs to come back and look at it again. Because, this frequent changing of rules, etc., is also, see, these are the operational minor things which also need to be addressed while we look at the broader issue of course, the sovereign rating.
Sure. I would like to move to Ajay Manglunia.
So,
Yeah, sorry. Ajay, you want to get in?
sorry, I think Beksy's made some really important points there, and sorry, I won't take more than a minute. But I think what is important to understand is if more people, more investors in India domestically echo some of the opinions that Bekxy is very correctly echoed, and this gathers some crescendo. Hopefully, it will get the regulatory authorities to look at this situation. Unfortunately, the way they haven't till date. It's very important to understand that an international investor, even if he's an emerging market investor, is looking at 20 or 30 different economies to invest in. And some of this red tape, some of all of these issues, and we keep saying we've eased it and we've eased it, but quite frankly, eased it from where? I mean, you set the bar so low that you've got miles to go before, it becomes easy for them to do it. And their travails and frustrations are, particularly when you sit outside the country, you hear this echo all of the time. I think the message has to be loud and clear. let me take the example of trying to carve out special securities where FIIs can buy without a limit. Now, that's a very orchestrated rule to create. Rather than that, could you not have identified bunch of securities, let's say 20 of them or 10 of them, which have a large enough consolidated size? And we all know that, we very quickly hit 100,000 crores or whatever worth of issuance in one security, and then that goes off the run, and then we create a new on the run. What if we identify 10 such securities and we allow those 10 securities to become euro clearable and issue their counterparts in the international market? You will suddenly have and the availability of an of an Indian government bond outside of India. You'll have a much more liquid market in those securities, and you will not force every investor to actually have to physically come and create infrastructure within India to participate in Indian securities. And lastly, all of this discussion of getting India into the bond indices has a very simple answer. If you do this, you will become a part of international indices. So, you solve a lot of problems if you take a little bit of your draconian hat off and start thinking more constructively of going towards foreign money rather than sitting inside and trying to knock on the doors of foreign money and say, please come in.
Sure. Ajay, that's very important points you've raised, and we will definitely highlight these to the regulators and policymakers. Moving on to Ajay Manglunia, Bekxy touched upon a very important point about the support given by government and RBI in various forms in terms of liquidity support and the stimulus package. In your thoughts, are they being effective? And is there a scope to do more? And if yes, what is it you're looking into?
So they've been quite effective, and RBI has thought out of the box in terms of providing those stimulus packages. And we have never thought that RBI can probably do some kind of a TLTRO or LTRO wherein they will provide the cheaper funding. And the banks, who so far have been very shy in terms of making any corporate bond investments, have all of a sudden come to market and started buying those corporate bonds. And that's kind of a comfort and liquidity provided to the market. You might have seen that in the month of March, where people were struggling to sell a AAA rated paper, and they were able to, they were forced to sell all those papers even 150 basis point higher. So all of a sudden, with the illiquidity in the bond market, it kind of made everybody worried, and it was looking like things are going out of the way. And all of a sudden, then RBI came to the rescue and kind of provided. One is the early policy by way of cutting down the rates, and then at the same time providing market liquidity by way of handing over money in the hands of the bank only to buy corporate bonds. And that has kind of given a lot of relief and stabilized the market. As we see, the regulators and especially the RBI's points are, or the mindset is to basically provide calmness and kind of a direction to the market rather than having any kind of a target about rates or structures or any kind of a level. So they have been quite effective. They have been doing out of the box initiatives to kind of provide a calmness to the market. And today, if we see, the levels of corporate bonds have drifted down by at least 250 to 300 basis points. And it's by way of providing comfort to the market, at the same time providing liquidity which was needed to the market without doing anything on the credit side of it and all that. But I think apart from all of that, they've been kind of on and off with the large borrowing on the state as well as center side. RBI has been kind of very, very prompt and has been able to do the auctions and twist and all of those measures to make sure there is enough liquidity in the common securities, because common security is the basic and that provides a benchmark for every kind of a rate to the market instrument. So that's a kind of a direction provided by the RBI to the common securities market and the yields and successfully conducting all of those auctions. We have never seen 30,000 crore worth of common securities being auctioned every week, and that's effectively they've been able to do. Even they've been exercising the green shoe and being able to get the market participants without having worries about supply and rates may eventually go up. That is one. And second, apart from these government securities, they have state loans, they have kind of T-bills, and all put together, if you see, every week RBI has been borrowing for central government to the extent of 70 to 80,000 crore worth of borrowing. That's a massive, and we have never seen such kind of a borrowing in the history of Indian government. And that has been doing successfully, and we have not seen any kind of a bumps in the rates level or any kind of a discomfort in the investor's mind. So that's a commendable task, and at the same time, giving a calmness to the currency and making sure that the currency is not either depreciating or appreciating, providing a kind of a relevant intervention and making sure that the currency levels are maintained, though without having any kind of a level in mind. So RBI has been doing a fantastic job. And I think in terms of making sure that market remains orderly and they have a lot of tools in their hand, and probably we don't know what are the options they have. Whenever they come out with the option, it's always innovative. So I'm a big fan of Mr. Das, who has been kind of given a direction to the market, and at the same time, very, very prompt and effective in terms of his relief and stimulus.
Sure. Thanks, Ajay. Before moving to the last segment of our discussion, again, we are running out of time, but I would like to come to Rajat now. Rajat, again, just building upon what Ajay just mentioned, Brickwork Ratings happens to be the third largest rating agency in the country today. And you've been seeing ratings across the spectrum, across asset classes. How are you seeing these measures taken by government and the central bank translating? And are there any green shoots which the investors should know about this? How are you seeing the measures translating into an action?
Yeah. So as I said earlier, some movement has started happening, some confidence has started coming back, especially in the rural focused sectors. So that's where right now our rural economy has been driving the country, and that we are all looking forward to more consumption from there. So we've in the past talked of more urbanization. I think right now rural is what's driving everything. So I think the sectors focused there, whether it's the auto sector is something that everybody looks at to say how the economy is doing. So I think two-wheelers, tractors are segments that are expected to recover faster than the others. If the FMCG sector, whatever essentials and so on, that's expected to continue to do well with the logistic problems going away. There is a lot of rhetoric that's happening now on, I think, not just in India but globally, on nationalism versus the open trade and so on. But I think there is move possibly started by US, but now a lot of other countries looking inwards. They keep talking about inwards for consumption and promoting industries, but I think it's a lot to do with nationalism. So if that were to happen, then a lot of chemical industry which is there, for which we depend on other countries, largely China, but also other countries, is something that started to move into India, and that's a possible sunrise sector. So these are some of the areas that will do well in the near future. And on the flip side, real estate, which has been a real big sector, both in terms of investments of domestic investors, individual money, and foreign investors, is going to struggle. We've started hearing of some talks of prices finally coming down. Possibly this is the time when it will eventually happen. But that's a sector, and all associated sectors, and there's a lot of employment that these sectors generate. So those are sectors that will continue to struggle, in addition to the tourism and hospitality, which obviously right now is completely frozen. Satish, you're on mute.
I'm sorry for that. So again, we'll go to the last segment of our discussion. I'll go to each of the panelists, request to keep your answers short, and be honest, in terms of what are your interests. So Lakshmi, first to you, which sector you're overweight and which sector you're underweight? Or sectors rather, let me put it this way.
So the sector which issues the maximum debt is the NBFC sector. So ironically, though my equity counterparts will be underweight NBFC, we are actually overweight the NBFC sector given their issuance pattern. We are obviously overweight the PSUs quite dramatically because as per regulation, they don't have any sectoral cap. So by default, they happen to be the highest overweight apart from the sovereigns. And yeah, so I think these are the two key things. Selectively, we also have been owning telecom space because we've seen some issuances on the telecom side. And so these are the key things because otherwise on the debt side you don't really see too many real sector overweights getting to be quite significant because they're quite fragmented in nature. Yeah, oil and gas you can say it largely rests with one entity in the industry, largely one. There might be a
And
couple of them. So
debt.
these are the few sectors that we are overweight.
And they're not looking for any debt in the
Sorry,
future. They're not looking for debt in the future.
that is
one
the
didn't.
problem. That is a problem. So where do you go? It's getting to be the Tina. There is no Tina in our audience, but it's getting to be there is no alternative factor slowly but steadily.
Correct. And which sectors you are like completely like now untouchable or not looking into it?
So right now, mid-market NBFCs, we are not looking at it. Microfinance, we are not looking at it. Real estate, these are the segments. Cyclicality, basically, wherever there is high-end cyclicality involved, there is high-end political intervention possibilities, which get further accentuated because of this medical emergency. Those are the kind of sectors, including the ones which I mentioned right now, where the deleveraging is taking a little bit more time, like real estate, for example, inventory. Liquidation is getting to be slightly more tardy than the rest of the sector. Like those are the segments that we remain cautious. We might do cherry picking if required, but en masse overweight in this category is not on the cards for us right now.
Sure. Moving on to Ajay Manglunia, what kind of issuers are tapping the market? What is the flavor in the market? Which sectors are looking better poised to get investments, and which sectors are not looking poised?
So as of now, it's the interest of investors to buy the PSUs. They feel it's a safer. There is not much of credit concerns, and their balance sheets are pretty clean, and it's all what you can believe upon that. Otherwise, people in terms of are very concerned, as Lakshmi was rightly saying, that they are concerned about making investment in the microfinance companies or mid sectors of NBFCs and real estate. And even the people who have exposure to all of these sectors, they are also kind of slightly penalized by the markets by way of not able to borrow from the market and all that. But otherwise, I think people want to lend, not looking at the returns, but wants to be sure that their money is safe and they can get it back. So safety is the biggest motto in terms of the market and that. So people are happy to keep money in the liquid place where it's overnight and remaining with the government rather than chasing the yields. And so if you see the rates on the shorter tenors are in the range of either 3 to 3.5% or 7 to 10%. People don't want 7 to 10%. They are happy with 3.5%. They want to preserve capital rather than having any kind of a rate for getting it back.
Sure. Bekxy, your thoughts? Where you are excited, which sectors are looking promising to you, and the sectors which is not interesting at all?
There is no excitement at all. Unfortunately, in the debt market, we really don't have much choice, unlike equities. Because the companies I would be excited, let's say a Britannia or Infosys, they don't issue debt. Simple matter. So I have to choose from the companies that actually come to the market, which are investment grade and issue debt. And in that we have very few sectors. We only have barely 3-4 sectors. And most of us institutional investors would follow bottom up approach, not a sector approach really. So I may have one agri-chemical which I invest in, and I may have one something. So, but that doesn't mean I am gung-ho on agri-chemicals as a sector. They may be that just one company I invest in. But overall, I think I agree with Lakshmi. It's AAA, PFIs, and oil and gas. If you see our portfolio compositions, which are right now occupying the majority space.
Okay. Ajay Marwa, your thoughts? I know you're very bullish about India, but then your thoughts on the same.
So So I think international investors are always looking for uh, is opportunism, right? So if you're going to see at the moment, like Ajay mentioned, PSUs are the flavor. If you get quasi sovereign debt, which is paying 3.5% sort of dollar return, that's quite attractive. But I think the bigger constraint, and I'm just looking at one of the questions on the comments that was posted as well, is what sort of credit from India can sell, and can Indian mid-market credit sell? Um, the answer to that question, and the answer to the issue that you've raised very correctly, Satish, is yes, it can sell. So can we sell double B rated credit from India today? Can we sell double B minus rated credit? Of course we can. However, we ourselves, so whereas the right hand wants to sell it, the right hand needs the money. The left hand puts a cap on the ECB at 450 basis points and ensures that the right hand can't sell it. So we've got to have the two hands talking to each other and talk as one body. And I think that's always been the problem in India, right? That there is the problem is we do not look at this holistically. We do not look at issues holistically. We manage our own sort of domains very well because we're very competent. But we're very competent in our domains. We are not very competent in looking at situations across, the entire space and doing what's correct overall.
Ajay, if government plans to monetize the deficit at this stage, would it be a good plan or a good strategy?
Uh, Very good question, and I'm going to answer that with a question. What would you rather do? I mean, and this is for all the eminent panelists here, and would you rather monetize your deficit, or would you rather enable your regulations to borrow from people who are willing to lend to you? I mean, the answer is out there for all of us, right?
I guess that's a fantastic answer, Ajay, and I guess it really hit. I'll again come back to the panel on quick questions, quick answers, and these are thoughts which are, probably which is playing in the mind of everyone. I'm not going to ask you questions about what is your number on GDP growth or on inflation targets or on interest rate. Well, there's lot many out there, but simple questions which is concerning all of us. First one, and again I'll go with Lakshmi first. Do you expect a moratorium 3.0 coming in?
No ways, please. We need to live and we need to breathe more air, especially with masks. Anyways, breathing has become a little bit difficult. No M3, no M3, which is money supply, and no M part 3, no ways, not at all.
Bekxy, your thoughts?
I hope not.
Ajay, Manglunia?
So,
Sorry.
It basically spoils the credit culture. So it was the need of the hour at the point of time, but we should not make it a practice. We should not make it a habit for people that नहीं पैसा देने से चलता है. Which is not something.
Sure. Ajay Marwa, your thoughts?
So I'm going to borrow this phrase. I'm going to borrow this phrase from Lakshmi. She said, you may have a Tina situation, and unfortunately, as far as the M3 in this case is concerned, it could be Tina. You may have no choice, right? We don't know what's the south end of this crisis, and if you don't know the south end of this crisis, then quite frankly, every single solution is in play. So please do not rule it out. And I would just advise every domestic investor to buy adequate number of masks. You may need them for a long time.
Sure. Rajat, your thoughts? You expect a Morat 3 to come in?
So I think it's time to get rid of Morat and look at other ways. Look at only the sectors where some support is required and give that support to those sectors rather than just openly giving that to everyone. In fact, I was speaking with somebody yesterday who is an auditor in many companies, and he said that the clients have been calling and asking, definitely something is going to come, Morat is going to come, or they are also expecting that government will waive the interest. So we have stopped making payments even though we can, right? Because what if that waiver comes and we have paid already? So this is the same situation that happened to farm loan waivers, where farmers would not pay because they would expect that waiver would come, right? So I think we need to have some other solution than doing this.
I think this is a great point by Rajat. I think if at all moratorium is going to come, you'd need to be more granular and more specific to deserving thing and not have a culture of, then again, willful defaults.
Yeah. So the message is very clear to the policymaker and the central bank. The
But
investors are
Satish, if you speak with most of the lenders
yeah.
between M1 and M2, you actually see that M2 behavior is way better because of opt-in. You're actually finding a lot of payments. So when it was, if M1 was 8 out of 10, M2 is just 1 or 2 out of 10, which is a very healthy trend. So I just wish and pray, as I said, we don't want this. Living in a lockdown situation, one would have assumed that you would have gained weight, but if you are a fixed income money manager, you only lost weight. We don't want that to happen again.
Yeah. So I guess on that note, the investors have spoken their mind. They're very clearly, unanimously saying that Morat 3 is not an option. We are going to get into a more structural issue. So yeah. So if the central bank is listening to this, the investors have spoken. So I guess this is a cue. Lastly, I would like to come on 2 points, just 2 points, and I will only limit this question to the mutual fund participants here. One of the participants has actually attendees have written that he's a senior citizen, retired person. Where do they invest? So there's a question. Lakshmi, you would like to take it first.
So my father is a senior citizen. He has no stream of income. He still has his money in our own balanced advantage fund. Given the fact that he does not require money, he already has some of his pension money which he's been utilizing. It will be a tad volatile, obviously, because it toggles between equity and fixed income. So that is one option, no doubt. Second option is you can look at debt hybrid funds. Now, these debt hybrid funds are typically tail-ended allocations to equity. The pure fixed income incrementally will give no joy because the rates, absolute rates, have come down quite dramatically. So unless you are looking at only fixed income, fixed deposit kind of alternatives, then it is pure fixed income. But otherwise, hybrids should clearly be the way out, even for senior citizens.
Sure. Bekxy, your take. Where should the senior citizens
So,
invest?
So senior citizens enjoy preferential rates on fixed deposits. And the current situation where we have, short-term rates, money market rates have crashed. So probably for their fixed income allocations, and if they have relationships, long-standing relationships with their existing banks, and they're getting preferential rates, then they should go for it. Continue with that. And for some of the inflation-adjusted extra kicker in returns, they can consider some small allocation to equities. But they should be careful, and it would depend on case to case basis. What is their overall savings, what is their monthly outgo, risk appetite, health conditions, etc. So it would vary case to case. Ideally, consult a financial advisor is what I would say at the end of it.
Sure, Bekxy. Thanks for those wise words. Well, we come to the last question. I would again request each of the panelists to keep it short, but it's a very pertinent question. Uh, we have so many Indian businesses out there, who is struggling to make their ends meet at this stage. They're also one of the largest employers if you look at collectively in the country. What is your one piece of advice in terms of staying afloat and staying investable from investors like you? So, Ajay, you would like to go ahead and give a slightly global perspective, and then I'll come to my domestic participants. Ajay Marwa.
So I think the most important thing at the moment is managing your own cash flows. If you want to be investable, because particularly as far as the debt perspective is concerned, growth outlooks will always remain growth outlooks. And they are, quite frankly, in my view, for equity investors to look at. As far as debt investors are concerned, you've got to make sure through various means, through whatever you want to do, stay lean and ensure that you have adequate cash flows and provide that comfort constantly. So communication levels with investors have to be at an all-time high. Declare your risks to any cash flows and make sure you've got adequate cash flows to keep funding.
Sure. Lakshmi, over to you.
So I think risk is the most forgotten four-letter word in good times, and these are not the best of times. So keep risk clearly on top of your radar, and staying afloat means you don't let water go into your lungs, literally when you are in the water. Likewise, today when you are in this, liquidity glut, it's important not to get carried away by excessive leverage. So keep your balance sheets lean and mean, as I said, and don't forget risk. That's very critical.
Ajay Manglunia, your views, quick
Yeah,
views.
yeah, I think it's an environment where the capital is a shortage and you can't afford to burn your capital. So for a longevity, for to survive in the country, for the surviving in the business, you have to be profitable. Without profitability, you can't run your business for a longer period of time. So in terms of having a longevity, you need to live profitably, and you just can't afford to keep burning capital. So you need to offload. Obviously, risk and leverage are the two important aspects which will allow you to stay afloat.
Yeah, so low leverage, preservation of capital. Bekxy, your thoughts, quick.
So just to add to what all the panelists have made excellent points, learn to live in the new digital age. Realign to the new digital age for yourself, your vendors, and your customers, because you cannot forget them. Without your vendors and customers, you can't survive. So get technology on your side, because this will last for a longer time than what we thought, this pandemic. And you have to align your business to the new reality, and those companies which can align and demonstrate to investors like us that, hey, we have got this technology, we are now in connect with our customers digitally, we are doing our collections digitally, we are doing XX, which we were earlier doing physically, they will get the confidence of the investor. And you have to be proactive in your communication. It can't be the standard quarterly financials, report, con call. You have to go ahead and proactively show that you have, realigned to the new digital age.
Sure. Rajat, I will have you. I'll have the last word for you. Your quick comments, and then we have to close the session.
Yeah, I think everybody has spoken of it. It's time to be prudent. Business models will need to get realigned. You can't do business the way you've done in the past 50 years. So it has to change. And there are opportunities that are there. People need to align themselves and their business models to those opportunities. And this is not the time to leverage more. There is money available cheap. That doesn't mean just take that money. You also need to align your liquidity and cash flows and so on with that money that you're taking.
Sure. On that note, I would like to thank each panelist, Lakshmi Iyer, Bekxy Kuriakose, Ajay Marwa, Ajay Manglunia, and also Rajat Bahl. We had a wonderful discussion. I'm sure the attendees would have enjoyed the discussion. We hope to bring in more such kind of events and discussions, again, with a different and a slightly different perspective and a twist in terms of how we are going to see how we are going to come out of this pandemic situation. So on that note, I would like to thank each one of my panelists. Thank you.
Thank you.
Thank you.
Thanks,
Take care.
Satish.
Thanks for having us.
Bye.